Good morning and welcome to Financial Accounting. We are in week 10 at this point, and so after this week, 5 more weeks to go. We're 2/3 of the way through the semester. Not quite 2/3 of the way there as far as points available for the semester. Last class we started chapter 9. We'll be finishing that up today. So you should have your chapter 9 exercises open in See Now. We'll be starting with exercise 6 today. We'll go 6 through 10 and then jump back to exercise 1 that we skipped over on Tuesday. So the chapter 9 exercises should be completed and submitted for grading by the end of the day today to be on track with the syllabus. And then next class, Tuesday, chapter 9 problem, and because we'll be starting chapter 10 on current liabilities, you should be submitting the chapter 10 pre-quiz at that time as well. As you know, chapter 9 is the third and final chapter for exam 3. And so I do have a review session scheduled for next Wednesday. That review session will be on Zoom, 9:30 to 10:30, Wednesday, November 2nd. Please join us if you can. Sign up in Starfish, and that's how you get the Zoom link to join us. Any questions about any of that? Okay. So, moment here. So as we go to our exercises, again, the first exercise for today will be exercise 6, but I want to, as usual, do a brief recap of what we talked about on Tuesday that will lead us into this first exercise for today. So on Tuesday, we talked about depreciation, why we do depreciation, what depreciation is. So we do depreciation because of the matching principle, because we need to record revenues when we've earned them and then match against them the expenses that go with those revenues for this period. And so when we make a long-term or capital purchase that's going to benefit us over more than one accounting period, we need to record that expense over more than one accounting period. So depreciation is the accounting technique that we use to take that upfront cost of that long-term asset and spread it out over its estimated useful life. On Tuesday, we did exercises related to recording a long-term purchase. When we make that purchase, we talked about the costs that would be included in there beyond just the sticker price. We talked about the importance of correctly categorizing land, because land, although it is a long-term asset, it's not depreciated. So that makes it different than the other long-term assets such as buildings, equipment, and so on. Once we record that asset, start using it for its intended purpose, start using it to help us run our business in the normal course of operations. At that point, we start recording depreciation. We covered 3 different ways of calculating depreciation. You are responsible for all 3 of those. They are straight line depreciation, units of activity or units of production method, and then double declining balance method. So you are responsible for being able to calculate and use each one of those 3. And so that's where we ended class last time. Does anyone have any questions about what we covered last time about the first half of this chapter? Okay. So as I tried to stress on Tuesday, when we calculate depreciation, it is based on what I call the hard number, a verifiable number, which is the actual upfront cost of that asset. But then also in that calculation is 2 different estimates, and either one or both of those estimates is likely not 100% accurate. And so the 2 estimates that go into our calculation are how much is this asset going to be worth when we're done using it, which I called the residual value, or the salvage or scrap or trade-in value. All those terms kind of mean the same thing. And the other piece that we estimate that goes hand in hand is how long are we going to use this asset, or what is its estimated useful life? And so in this exercise, exercise 6, what we are looking at is a situation where one or both of those original estimates we find out was not a very good estimate. Again, doesn't mean we did anything wrong. We did the best we could with the information we had, but turns out maybe something changed and our estimates are not valid, are not accurate. And so when that happens, when we learn new information and it's a material change, that is, it's a change that would make a difference in a decision maker, we may have to do what we're going to do here, which is revise our depreciation partly through the life of that asset to take into account what do we now know to be the case. And so exercise 6 is titled Revision of Depreciation. And it says, a building with a cost of $2.2 million has an estimated residual value of $85,000, has an estimated useful life of 40 years, and is depreciated by the straight line method. So letter A is review of what we did last time. What is the amount of the annual depreciation? So I'll show you that calculation just as a way of reminding you. Remember, we do have that page of formulas and terms in the reference materials folder in Brightspace as well. That's where this formula would come from. And so to calculate straight line depreciation, we take the original or historical cost, subtract from that the estimated residual value, and that difference is called the depreciable cost. It's the amount of that original value that we are going to use up, and therefore the amount that we need to record as expense. So we are going to use up $2,115,000 worth of this asset. And that's again the depreciable cost. And we're going to depreciate that over 40 years. So if we take that depreciable cost and divide by the estimated useful life of 40 years, we find an annual cost of $52,875. Whoops, not our year. Any questions with that calculation? Again, review from last class, how to calculate straight line depreciation. We record the same amount of depreciation every year for 40 years is what we plan anyway when we acquire this asset. So the next question says, what is the book value at the end of the 28th year of use? And so we saw the formula, we talked about book value. I also used the term carrying value because that's the amount that we are carrying on our balance sheet. And so at the end of the 28th year, and we'll assume that all 28 years, in other words, the first year was a full year. So we talked about last class that if we do not put that asset into use in the first half of the first month of the year, we would need to prorate depreciation, record partial year depreciation. We saw last class how to do that. I think it was in exercise 5. And so at the end of the 28th year, we start again with that original cost of 2.2 million, but we have subtracted from that 28 years, full years of depreciation, 28 years of recording $52,875 per year. So we have recorded as expense $1,480,500. That's 28 years of $52,875 per year. And we're going to subtract that quantity from the original cost to find our book or carrying value at the end of the 28th year. Everybody good so far? Okay, so A and B, both review of last class. You should be comfortable with those. Letter C says, if at the start of the 29th year, so we've just recorded year 28 of $52,875 worth of depreciation. And at the beginning of the 29th year, they looked at this and said, you know what? We thought we'd use this for 40 years. We thought we had 12 years left for depreciation. But we're now looking at this building saying it's not still going to be good in 12 years. In fact, we think we're only going to be able to use it for 5 more years. And at that time, rather than the value of the building being $85,000, which we had originally thought, the value is expected to only be $60,000. So question C asks, what is the depreciation expense we're going to record for each of the remaining 5 years when we take into account this new information? So it's almost like starting from scratch. It's almost like starting over with our calculation. We take the current book value of $719,500. We subtract from that the remaining value to get the remaining depreciation. How much more depreciation do we need to report? The remaining depreciable cost then is $659,500. Label on that. So that is the remaining, whoops, depreciation or depreciable cost. So what do we do with that? Well, we need to record that total amount of depreciation over just 5 years. And so we're going to take that depreciable cost that remains and divide by the remaining useful life. And we determine that we will need to record $131,900 in depreciation for each of the remaining 5 years. So it more than doubled. It more than doubled our depreciation. Why is that? Why did it go up so much? Because it turns out the first 28 years we used this building, we weren't recording enough depreciation. It was an honest mistake. There's no reason to think that our original estimates were done in any kind of attempt to, fraudulently prepare our financial statements or anything. Using a 40-year useful life for a building is pretty common. There's no reason to think that those numbers were not reasonable at the time that we started using that building. But something changed. And so now we're playing catch up. We're going to be recording a lot more depreciation for the next 5 years because we're catching up the fact that for the first 28 years, we didn't record enough. Does that make sense? Everybody okay with those calculations? So we just had to recalculate based on the new information we have, because that's a significant difference. That is what we call a material difference. It could make a difference to someone looking at our business and trying to make a decision based on the information we include in our financial statements. So it is necessary for us to make that change as soon as we become aware that, hey, this building's not going to last us 40 years. And it's not going to be worth as much as we thought when we are done using it. Everybody good so far? So I told you last class that what we were going to do for this first portion of the chapter is to go through the entire life cycle of the fixed asset. And so we talked about how do you make the decision that you're even going to buy this asset, because you do the cost benefit analysis and it's worth it to us. It's a good investment. It will help us make more money or save more money. We talked about recording the purchase of the asset, recording depreciation as we use the asset. We've now talked about what happens when things change and we have to change our previous assumptions, how we change that depreciation. And now we're at the very end of the life cycle of the asset. And we're done using this asset and we are going to dispose of it. So what does that look like on our financial statements? So exercise 7 is disposal of fixed asset. So the first step in recording the disposal of the asset is we have to know how much is it worth right now according to our books. We need to establish the book or carrying value of this asset. And so that's what we're going to be doing in part A and B. Equipment acquired on January 6th, so first half of the first month of the year, at a cost of $425,000, has an estimated useful life of 20 years and an estimated residual value of $35,000. In part A, we assume we're using the straight line method of depreciation, and we need to calculate the depreciation expense for each of the first 3 years. I'm going to pause the recording and ask you to do part A and B on your own. This is review of what we've already done, calculating straight line depreciation and then the book value at the beginning of year 4. So please go ahead and do that on your own. Once you're done with that, go ahead and restart the recording if you're watching on. Okay, so I found an annual depreciation of $19,500. And if we record that for 3 years straight, then at the end of the 3rd year or the beginning of the 4th year, the book value or carrying value of that equipment would be $405,500. Now, the way we've talked about it, depreciation is not, one thing depreciation is not, is an effort to make the value of that asset on our balance sheet be equivalent to its fair market value. That is, if we sold it today, how much could we get for it? That's not what depreciation is. As we've discussed it, depreciation is taking that upfront cost, determining how much of that are we going to use up, that is the depreciable cost, and then taking that depreciable cost and dividing it across the useful life using some one of those 3 methods. In this case, straight line, same amount every year. And so when we finish the 3rd year, start the 4th year, the book value of that equipment is $405,500, but that does not mean if we sell it right now, we can get $405,500 for it. It might be worth more than that. Yes, sir. Okay. What did I do? Let's see. 420. Oh, yeah. You're right. The formula that thank you. The formula that I have there is correct, but I did not punch it into my calculator correctly. I actually only subtracted 1 year. We try that again. 425,000 minus 58,500. 366,500. Thank you, Ethan, for pointing that out. So 366,500, is that better? So the formula was there. I obviously didn't check my answer for reasonableness. Doesn't make sense that you'd subtract about $60,000 from 425 and get whatever I had on there, 405. So back to what I was saying, though, thank you for helping me fix that. The book value is now 366.5. That does not mean we can sell it and get 366.5 for it. We might get more than that. We might get less than that. It may not have any value at all. We might have to throw it away. We might have to pay someone to take it off our hands. What we're going to be looking at in part C is we actually are selling that piece of equipment now. And what would happen? How would we report this or record it if we sold it? As you can see in letter C, we're selling it for less than our books say it's worth. Letter D, we are selling it for more than our books say it's worth. So my assumption is, unless something really happened, unplanned to this equipment, if we expected to use it for 20 years, that at the end of the third year, it would not have no value. But that could happen. What if we found out, for example, that this equipment was really dangerous? And so nobody wants it because it's not useful anymore. Or it's had a major catastrophe. Think of your Tesla car and the battery goes and it's $26,000 to replace the battery. You might not think that's worth it. So these are the two most likely scenarios that we sell it for something, and the cash we get from selling it might be more or less than the book value. But most of the time, especially this early on in the useful life of that equipment, it's not going to be worthless. It might be just that this company has decided that a different piece of equipment would be better for them. Maybe they're growing and they need a bigger piece of equipment. All those things are possible. And so when we sell the equipment, our journal entry is always going to include how much cash did we get for that. As long as we sell it, there's going to be some cash involved. In letter C, that cash was $360,000. In letter D, we still have cash involved, but now it's $370,000. But anytime cash changes hands, we know that's going to be included in our journal entry. Well, what else do we know? Well, this equipment that had an original cost of $425,000, if we think about how that's appearing right now on our financial statements, we show the equipment at $425,000, and then in the contra asset related account, we show the accumulated depreciation of $58,500. If we are selling this equipment, we need to remove the equipment from our balance sheet. And at the same time, we need to remove that accumulated depreciation related to the equipment. We don't have it anymore. We need to get it off our books. And so both of these entries are going to include a credit to equipment to get the equipment off our books. And they're also going to include a debit to accumulated depreciation. I may have to adjust one of these lines as we go along. It's also going to include a debit to accumulated depreciation because that account goes along with the equipment and we don't have the equipment anymore. So we want to get both of those pieces off our books. We know that the equipment had a debit balance, so to clear that, to remove it, we need to credit the equipment account. We know that the accumulated depreciation is a contra asset. It has a normal credit balance, and so to get that off our books, we need to debit that account. Everybody good so far? They said, I think I'm going to have to move one of these lines, but it's okay. I'll fix it when we get there. So what do we see now? If we look at journal entry C first, how much do we have on the debit side? 360,000 plus $58,500. We have $418,500 debited and $425,000 credited. Can our debits be more than our credits in a journal entry? Is that possible? No. And so I need another debit. I'm going to have to clear that part out and move it down one line, because I need another debit here to make this transaction balance. My two sides, the debit and credit side, were out of balance by $6,500. I need to debit $6,500 more to this, add that to this journal entry to make it balance. And so now the question is, what is that $6,500? We sold the equipment for less than the book value, right? In B, we said the book value, once I fixed it, was $366,500, but we only sold it for $360,000. That $6,500 is the loss that we took when we sold the equipment. Loss on sale of equipment. What does that really mean, though? What does that really mean? It means that the first 3 years we used this equipment, we did not report enough depreciation. I'm not saying we did the calculation wrong, but our estimate was wrong. And so that loss on sale of equipment, that debit balance, looks like an expense, right? That loss is going to show up on our income statement. It's going to reduce our income for this period. Why? Because we now know the last 3 years, we probably should have reported a little bit more depreciation each year, a couple $1,000s extra. Doesn't mean we did anything wrong. We really weren't planning to sell this equipment at the beginning of year 4. We had planned to use it for 20 years when we bought it. But now we're playing catch up and recording that additional expense beyond what we had originally calculated. Make sense? So how about letter D? In letter D, we sold it for $370,000. We sold it for more than the book value. So again, our journal entry is not in balance. We have $428,500 on the debit side and only $425,000 on the credit side. For this entry, we need an additional credit of $3,500. So if that was a loss in letter C when we sold it for less than the book value, what do you think it is when we sell it for more than the book value? It's a gain on sale of equipment. Again, we're making up for the fact that we recorded a little too much depreciation each of the last 3 years, about $1,000 extra. We didn't do the calculation wrong, but our book value did not exactly match up with the fair market value. Remember, that was intent in the first place. Anybody with questions on exercise 7? Okay, so now we know how to record it when we sell that equipment. If we had disposed of it as having no value, the entire carrying value or book value would have to be written off as a loss. The opposite of that could actually happen. It could be that we have fully depreciated the asset. So maybe we thought originally this asset's not going to have any residual value. We had one exercise on Tuesday where we assumed there was no residual value for that asset. And so if that's the case, if we have no expected residual value and we use it for the length of time we expect to, when we are done using it, the asset is going to have a 0 book value. But that doesn't mean it has no actual value. We could still sell it, even if we sell it for scrap metal, we could get something for it, and then we would have a gain. So it's possible to have an asset that we call fully depreciated. It has no value left on our books, but that doesn't necessarily mean it has 0 value in the real world. All right, any questions about that? So we've gone through the full life cycle of the long-term assets, depreciable assets. We know how to calculate we know how to record it when we acquire it. We know how to depreciate it as we're using it. We know what to do if something changes and we have to adjust our depreciation. And we know how to record it when we are getting rid of the asset, selling or disposing of that asset at the end of its useful life. Couple other things I want to talk about before we get to our next exercise. So we have already mentioned we have already mentioned that the idea of a capital expenditure. A capital expenditure is something that's going to benefit us long-term, and we add it to the balance sheet. We capitalize it and we record the expense over time. I need to distinguish that, what we've been talking about, from a revenue expenditure. A revenue expenditure is something we would call a period expense, something that's going to be recorded as an operating expense in the period in which it's incurred. Included in that revenue expenditures, things that don't go on the balance sheet, would be routine maintenance, getting an oil change in your car, or putting gas in your car. That's not even maintenance, that's just an ordinary operating expense. So capital expenditures go on the balance sheet. Revenue expenditures go right to the income statement. An extraordinary repair is an interesting case, because what we're saying is we've done something to this asset that actually extended its useful life. So we originally thought we were going to use it for 10 years, but we did this, and now we can use it for an extra few years. If there is that kind of a extraordinary repair, think of it as maybe, you need to replace the transmission in your car. So, but by replacing that transmission, it's going to run even longer than we would have originally thought. For an extraordinary repair, you can see the example journal entry here at the bottom. We would, instead of reporting it as an expense in that period, like an ordinary repair, we actually reduce the amount of accumulated depreciation. We debit accumulated depreciation and recalculate the remaining depreciation, just like we did in exercise 6. Asset improvements are capital expenditures. And so they would actually increase the value of the asset itself, the equipment, or in this case, the truck. And so we need to recognize when something is an extraordinary repair, it's not making it better than it was originally, but it's restoring some of the usefulness. An asset improvement actually makes the asset better than it was originally. So it could be putting in some new feature. It could be something that's installed and can't be removed. So in this case, the delivery truck had a hydraulic lift added to it. It is now better more useful, more valuable than it was originally. And so we add that to the historical cost and again, recalculate the depreciation. So it is important that we recognize the difference between a revenue expenditure, something that is a recurring cost like an oil change, something that really only benefits the current period. So we need to write off that expense all in that current period. Contrast that with a capital expenditure that is actually going to change the useful life of the asset, make it more valuable than it was prior to that change. And we talked about both of those scenarios, extraordinary repair and asset improvement. So we don't have any exercises related to those. Those are obviously a little bit less common than acquiring a new asset outright, making a change to the existing asset. Any questions about that? So two different scenarios that would require us to recalculate our depreciation based on that change to the asset value. Skip through this. Okay. So I told you on Tuesday that the majority of the chapter, so everything we've done up to this point was about what we call plant assets, property, plant, and equipment. But we have two more categories of long-term assets to talk about. And the next one and our next exercise relate to natural resources. So we talked about property, plant, and equipment being subject to depreciation. We're going to include a new term here for natural resources. We record depletion. Depletion. In order to be considered a natural resource on our balance sheet, it needs to be, as you can see on the bold face in these bullet points, naturally occurring, removed for sale, and removed and sold over more than 1 year. I would add something to this. It also needs to be used in our normal course of operations. So we might own the timber rights on a piece of land, for example, but if we're not a company that does lumbering, that does timbering, for us, that's an investment. We might own the mineral rights on our property, but if we are not a mining company, for us, that's an investment. So when it says removed for sale, it means that we are the ones who are harvesting and selling that. If we just sell the timber rights to a timber company to let them come in and harvest trees off our property, again, that's an investment, and we record the revenue when the sale takes place. The calculation of depletion, and you can see that term at the top of the screen now, the calculation of depletion really looks like the units of activity or units of production calculation for depreciation. So the depletion rate, you can see the calculation there on the screen. The total cost of the resource divided by the estimated total units of the resource. So let's say we buy a piece of property with the mineral rights, and we are planning to mine coal out of that property. We would need to, so we have a purchase price for the property, but that includes both the land and the minerals. And so we would need to separate those two pieces. The value of the land would be, how much do we think it's going to be worth after we've removed all the coal? And we would assign that to land under property, plant, and equipment. And then the rest of the value would be for the coal, the mineral rights. And that coal would be reported as a natural resource and would be subject to depletion. The value of the land is not subject to depletion or depreciation. And so just like with the units of activity or units of production method that we talked about last time, at the time we acquire the land, before we even acquire it really, we would calculate how much is this coal costing us per ton? We'd want to do that calculation to make sure it was worth it to us, right? Because if it's not worth it, if it's going to cost more for the coal and to extract it than we can get by selling it, we probably wouldn't make that investment in the first place. So we do that calculation of the cost per unit, which might be ton or pound, or I don't know, how else, gallon, barrel, if you're talking about oil, something like that. And we know how much that's going to cost us per unit before we even start harvesting the product. And when we start harvesting, we start reporting depletion based on the number of units that we actually removed. We report it as depletion expense in the period in which we sell the product. So in our exercise, we can go to that exercise right now. In our exercise, you'll notice that it says during the current year, 4 million tons were mined and sold. So the assumption is we harvested the, whatever it is, minerals, doesn't tell us what kind. We harvested the minerals and we sold them in the same year. That's important to know because if we didn't sell them yet, it's now inventory for us. It's still an asset for us. So it is important for this exercise that we're talking about a product that was harvested and sold in the same period. So let's go ahead using those formulas that we just had on the PowerPoint. Let's determine first the amount of depletion expense that we're going to report for each ton. In this exercise, you'll notice it tells us we acquired the mineral rights. What that means is we have a right to harvest the minerals, but we aren't going to own the land. Once we're done harvesting the minerals, our interest in that property is gone. We aren't going to own the land. And so there is no separate calculation of the value of that land. This is just the cost of those mineral rights. Whoops. And we paid $67.5 million for the right to harvest what is estimated to be 30 million tons. So it's not a calculation of how much do we think is there. It's how much do we think we can remove? How much do we think we can get out? And that's important because sometimes we know that there are deposits that are not readily accessible or not accessible using the current technology. Or it's not worth it to continue trying to get at, the last bits of it that are going to cost more and more to extract. And so when it tells us the mineral deposit is estimated at 30 million tons, that means that's how much we expect to extract. And so that works out to be $2.25 per ton. That's the depletion rate we're going to use, and we can calculate that before we do anything else. We would have calculated that before we even made a decision to buy these mineral rights. And it tells us in the current year, 4 million tons are extracted. So at $2.25 per ton, the depletion expense that we would report in this year would be $9 million. Everyone okay with that calculation? Again, it looks just like the units of activity or units of production method that we learned on Tuesday for depreciation. Letter B asks us to journalize the adjusting entry on December 31st to recognize the depletion expense. And so again, it's important to note that we're reporting this expense because we sold the those 4 million tons. If some of that 4 million tons was still in inventory, we would not report that as expense. We would simply categorize it as inventory. It's available for sale. But because we sold everything we mined this year, we're going to report the full $9 million as depletion expense. And the credit side for that would be accumulated depletion. Just like for property, plant, and equipment, the credit side was accumulated depreciation. So for depletion and depreciation, for property, plant, and equipment, and for natural resources, we use the contra asset to show how much of that value we have used up. And so anyone looking at our balance sheet, if they can see enough detail, can see, here's how much we paid for it originally, here's how much we've already used up, and here's the balance, here's what's left. Any questions about depletion? That's really all I have to say about natural resources. Okay, you guys are even quieter today than usual. I don't know why that is. Okay, let me get to my next slide. And we are going to move on to the third area covered in this chapter. So we spent a lot of time talking about property, plant, and equipment. We just spent a little bit of time talking about natural resources, and now we're going to spend a little bit of time talking about intangible assets. So intangible, does anyone know what that word means? You can't touch it. It doesn't have a physical substance to it. So it represents a legal right, but not an actual thing. It's a concept, it's an idea. You want to think of it like that. So typical intangible assets that businesses might have include things like copyrights, trademarks, patents, franchises, goodwill, brand names. The development of an intangible asset is kind of complicated. So I need to talk, let me put this term on the screen here. So many intangible assets that companies might legally own do not appear on their financial statements, because if they are internally developed as a result of research and development expenditures, also known as R&D, if they are internally developed as a result of R&D expenditures, the requirement is that R&D is expensed immediately. R&D is expensed immediately. So think about over the last 2 years, the vast amount of money that was spent on COVID research, vaccines, treatments, testing. Think about all the money that went into developing that technology, that knowledge. Those companies that spent that money, regardless of its source, whether it was internal funds, whether it was government grants or private foundation grants, whatever, that money, the value of that expenditure does not show up on those companies' financial statements. Even the ones who successfully developed a treatment or a vaccine doesn't show up on their financial statements. If you look at Pfizer and Moderna's balance sheet right now, even if you could see enough detail, you are not going to see a line item for the COVID vaccine. Well, it's patented, you'd think. It's a pretty big deal. It's making them a lot of money, right? But it doesn't show up on there. Why? Or why not? Because at the time they were spending the money, they didn't know what of that expenditure was going to result in a product that they could sell. And the vast majority of money that is spent on, especially things like pharma, doesn't ever result in a product that the company can sell. It falls apart at some point in the research process and never gets to market. Everybody understands that, right? The vast majority of money that's spent on pharma research is not profitable. So by our definition of an asset is something that helps you to make money, right? So all of these billions of dollars that are being spent on this research, we don't know if it's ever going to result in the company making money. And so by definition, then we can't classify it as an asset. So back to what I put on the screen, research and development expenditures by rule are expensed in the period in which they're incurred. They're expensed immediately in that same year. And so companies that end up with a product to sell have already reported all of the expense of developing that product. They still have to produce it. I'm not saying they have no more expense, but they don't have an asset. The intangible asset, the patent, is not sitting on their balance sheet. It's already been reported as expense. So how do we get intangible assets such as copyrights, patents, trademarks onto our balance sheet? We only get them by acquiring them from some outside source. So if Pfizer were to sell the patent to, I have no idea, some other company, if they did that, the company that bought it would have the patent and they would show that patent on their balance sheet because they know how much it cost. But Pfizer, all of the money that went into it has already been expensed and they weren't showing it as an asset in the first place. So that's one of the complicating factors when we look at a company's balance sheet and we say, is this really how much they're worth? When we see the total value of their assets on their balance sheet, does that mean that's how much the company is worth? So that's called the book value of the company. But we've already talked about how the book value of property, plant, and equipment doesn't match fair market value. It's not intended to. That we could have assets that we're still using to run the business that are fully depreciated. And so they're not showing up on our books at all as having any value. And now we see a big source of value in a company, which is maybe that COVID vaccine patent or the COVID testing patent or whatever. Now we see that the value of those for most companies also doesn't show up on their balance sheet. So what that should tell you is the total assets on their balance sheet are usually greatly understated compared to the actual value of that company. So how do you know the actual value of that company? You look at the value of their stock, if it's a publicly traded company. You can tell how much it's worth by looking at the value of their stock. So back to our intangible assets, we know we're really only looking at intangible assets that the company had a way of valuing, determining that initial or upfront cost. And that would be because they bought it from some other entity and now they have a concrete value to it. That off the screen so I can go. So each one of these intangible assets that I have mentioned has its own accounting rules associated with it. And the accounting rules have actually changed in the last 15 years or so. I would suggest if you encounter a question, either in this class or in the workplace, about and I should have pointed out that word, I apologize. So we talked about property, plant, and equipment being depreciated, natural resources are depleted, intangible assets are amortized. I think that was actually, the word was actually right here in bold on the previous slide. Amortization is the same concept as depletion and depreciation. It's using up the value or recording as expense, the value of that intangible asset on our balance sheet. What is different though about amortization of intangible assets? We report the amortization expense, but we do not typically use an account called accumulated amortization. Instead, we directly lower the value, the remaining value of that intangible asset. Some intangible assets are automatically amortized over their legal life or their estimated useful life, whichever is shorter. And so you can see, looking at patents here, patents are good for 20 years. And so if we have the cost of a patent on our balance sheet, we would need to be writing that off over 20 years because it has a limited useful life. If we have the patent to something, then the patent's good for 20 years, but we think we can only sell it for maybe 3 more years, we should only amortize it over those 3 years. So that's what I mean when I say whichever is shorter between the legal life and the estimated useful life. Through that. Okay. Copyrights. Copyrights also have a limited legal life. And you can see there the limited life of a copyright, 70 years past the author's death. Okay. You guys are using a book for this class that was published this year in 2022. I have no idea how old the principal author of this textbook is. My guess is he's writing a college textbook. I'm just going to ballpark it. He's probably at least 50, right? So let's say he lives to be 80, just throwing a number out there. And then, so that's 30 more years plus 70 more years until that copyright expires. How many people in here think if you have an actual physical copy of this book that it's going to have any value to the author or his descendants 100 years from now? Any chance someone's going to want to buy that accounting textbook 100 years from now? Not unless it's for a museum. The expected useful life of a college textbook is, they say, about 4 years. My guess is if you look at the textbooks you're using for any one of your classes, you won't find one that's older than 3 years old. And so if you own the copyright to a college textbook, even though you might possibly be able to argue that it has a legal life for another 100 years or so, that's not how long we should be amortizing it. Because there's no reason to believe that we're going to be able to sell it and make any money from it, even 5 years from now. So the matching principle tells us we should write it off over the time that we actually think we can sell it. A trademark has a potentially unlimited life. They don't expire. As you can see here, you can keep renewing that registration indefinitely. And so there's no requirement that we write off or amortize the value of a trademark because it has a potentially unlimited life and it could benefit the company for an unlimited number of years. Goodwill is an interesting concept. So goodwill is basically the amount that you're willing to pay to acquire some asset over and above the value of the tangible assets that you're buying. What are you talking about? Let's say you're going to buy a business. Honest John's restaurant right down the street from here. Let's say, I'm just totally making this up. Let's say that the current owner of Honest John's wants to sell it, wants to retire, move to Arizona, I don't know. And so let's say, I'm going to call him John, no idea. His name is actually John. Probably at some point, the owner was named John. Don't know if that's still true. So John wants to sell his restaurant and you're interested in buying it. And so you have an appraiser come in who tells you the value of the land, the value of the building, the value of the equipment that's going to come with that restaurant. And just to put a number on it, let's say the appraised value of all of that property is $100,000. No idea if that's true. Just throwing a number out there. $100,000. But John, because he's trying to retire to Arizona, is asking $150,000 for it. And you, let's say you agree to pay that. Why would you agree to pay that in the first place? Well, because it's an established business. Because he's got loyal customers. He's going to give you the recipe too, by the way, maybe if he's got some special sauce that he makes in-house or something. And so you might be willing to pay more than the fair market value of the tangible assets because of the goodwill that has been established for that restaurant. That he has a customer list, he has loyal customers who order from him every Thursday night or whatever. And so that's what goodwill is. It's the extra amount that you're willing to pay over and above the fair market value. And so goodwill does not need to be amortized because it has a potentially unlimited life, right? There's no reason to think that next year, Honest John's Pizzeria is going to be worth any less than it is this year. That you still have that $50,000 of goodwill that made you willing to pay more than the fair market value of the tangible assets you were acquiring. So does that mean we keep that $50,000 on our balance sheet forever? It might. But each year, we are going to do what's called an impairment test. We're going to look at that $50,000 in goodwill and say, is it still worth that? If we think it's actually worth $70,000 more, that's tough. We don't get to write up the value. We don't get to increase the value, just like we talked about on Tuesday with land. The assumption is over time, land does increase in value, but we don't get to just add that to our balance sheet arbitrarily. The same with goodwill. We don't get to increase its value, but in a given year, it might go down. And if it does go down, we would write off that reduction, that impairment. We would write that off as an expense. Again, we don't get to record internally generated goodwill any more than we get to record internally generated patents, copyrights, trademarks, franchises. Franchise shouldn't be on that list. So here's a summary. For patents and copyrights, we are going to amortize them based on how long we expect to be able to benefit from them, which can be up to, but not more than, the legal life. But I already explained why for a copyright, it probably is, in some cases anyway, less than the legal life. Because no one's buying your accounting book 50 years from now, or even 5 years from now, probably. The other two that are listed here, trademarks and trademarks and goodwill, are only subject to impairment because they have a potentially unlimited life. And so we can keep them at what we paid for them forever. But if we believe that the value has been impaired, we need to write that off at that time. And unfortunately, once you write it off, you can't bump it back up. So let me give you a scenario. Honest John's, you've got, in my scenario, $50,000 worth of goodwill when you bought the pizzeria. But next year, someone gets sick and claims that it was based on food that they ate at your restaurant. You think that's going to harm the reputation of Honest John's Pizzeria if word gets out that, you know, a family was sickened based on something they ate from your restaurant? True or not? Yeah. The value of that goodwill is going to go down. And so you write that off, that impairment loss. And then after you've done that, you start to reestablish your reputation. The next year, you might believe or know that we've reestablished our reputation. That was a one-time thing. It wasn't our fault, whatever. We don't get to unwrite off that impairment loss. We don't get to restore the goodwill to the full $50,000 it was. Once it's gone, it's gone. Any questions about what we've talked about up to this point before we go to our next exercise? Okay. Next exercise, exercise 9, amortization entries. Clean Company acquired patent rights on January 10th of year 1. Again, it's significant that that happened in the first half of the first month, just like we discussed with depreciation. You might have to report a partial year of depletion or amortization as well. So they paid $2,800,000 for that patent, and it has a legal life of 8 years, and they expect that that will be its useful life as well. So this company is going to plan to write it off over 8 years. If the useful life was less than 8 years, we would write it off over whatever that useful life was, 6 or 7 years or whatever. So I'm going to hold on to that last sentence for a moment, and let's go to letter A. Determine the patent amortization expense for year 4 ended December 31st. Oh, wait, here. Sorry, I need to read that sentence. I thought it was for year 3. On January 7th of year 4, Clean successfully defended the patent in a lawsuit at a cost of $38,000. So I think the easiest way for us to do this is for me to put a T account here on the screen for the value of that patent. So this patent would appear on our financial statements, on our balance sheet, as an intangible asset. If the company has significant intangible assets, they probably have a whole separate category on their classified balance sheet for intangible assets. If it's just a small category, they might throw it in with miscellaneous or other or special assets. So at the time they acquired the patent, they would report that as having a value of $2.8 million. That's what they paid for it. This patent, they expect to write off over 8 years. And so the calculation of amortization for a patent looks very much like straight line depreciation. We take the historical cost, divide it by the estimated useful life, and that's 8 years. Again, just like straight line depreciation. And so at the time we acquire the patent, we calculate, we're going to report $350,000 worth of amortization on the patent each year. And we do that for year 1, year 2, and year 3. And at the end of year 3, and remember I told you we don't have a separate account for intangible assets. We don't have a separate account for accumulated amortization. We simply reduce the value of, in this case, the patent directly, rather than setting up a contra asset account. And so at the end of year 3, we've reported $350,000 each year for 3 years, a total of $1,050,000. The book value of the asset then, the book value of the patent at the end of year 3, beginning of year 4, is $1,750,000. And so that's what's showing up on our balance sheet for the patent at the end of year 3, beginning of year 4. Make sense so far? Just like straight line depreciation, except we don't have that contra asset account. What does that last sentence say though? On January 7th of year 4, again, first half of the first month of the year, Clean successfully defended the patent in a lawsuit at a cost of $38,000. If you aren't aware, so patents are your legal right to some process, right? And so if someone is infringing on your patent, that means that they are using your process that they don't have a right to use. It's intellectual property, that intangible asset. They don't have a right to use it. We found out they were using it. We probably sent them a cease and desist order, said, hey, you can't do that. And they kept doing it. And so we took them to court. And the court ruled in our favor, but we still had to pay our attorneys for what the service that they provided to us. What if we hadn't taken them to court? We basically would be saying, yeah, we have the exclusive legal right, but we're going to let you continue doing that. And so the patent then doesn't have value to us. If we're going to let other people use the process that we own, the patent doesn't have value. And so the fact that we had to spend $38,000 to defend our patent in court actually increases the value or increases the cost of that patent. And so those legal costs, rather than being reported as legal expense that year, we are simply going to add it to the value of the patent. And so now, what is the value of our patent after that legal defense? We've already reported 3 years worth of depreciation. And so the value was down to $1.75 million, but the cost value to us just went up by $38,000 because of what we had to pay our attorneys. And so just like we discussed in the exercise 6 at the beginning of class today, we need to revise this amortization rate. What we're let's do that calculation. So $1,788,000 is the current value of this patent on our balance sheet, on our books. How many years more do we expect to use this patent? Its legal life was 8 years and we've already used it for 3. So we have 5 years left, right? It doesn't tell us that the estimated useful life. It wouldn't extend the life of the patent anyway. But it could have shortened it. They could have said, yeah, now we think we can only sell it for 3 more years or whatever. So that 1,788,000 remaining value on our balance sheet needs to be spread over 5 years now. Remaining 5 years. And so you can see that our amortization expense went up by $7,600 per year. That's the $38,000 additional dollars for the patent defense, our legal defense, spread out over the remaining 5 years. And so now to part A, determine the patent amortization expense for year 4. That would be $357,600 as we just calculated. And how do we journalize that? Well, we're reporting the amortization expense and reducing the value of the patent directly. So for the first 3 years, the entry would look just the same, except the dollar amount would be $350,000 rather than $357,600. But the accounts involved would have been exactly the same. And the entry for year 4, 5, 6, 7, and 8 would look, if nothing else changes, would look exactly like what we have here. If it turns out in year 7, let's say, that the process that we have patented isn't valuable anymore, nobody wants to buy that, maybe there's some new improved process that we own or someone else owns, and nobody wants to buy our product anymore. So maybe our process here is a tamper-proof lid, you know how they have on medicine bottles. You want to keep it they used to call it child-proof. Now they call it tamper-proof. And so maybe someone comes up with a better one, or if they find out that ours doesn't actually work. At that point, we would not want to continue recording the annual amortization. We would want to write off the remaining value as impaired, just like we discussed for the unlimited life, the goodwill and trademarks. Okay, any questions on that? Let me put my green check marks in there. Aren't any questions? We'll keep going. And looking at exercise 10. We've already talked about book value or carrying value, so we know what that means. Let's apply it in this exercise. Apple Inc., that AAPL is their trading symbol, remember. Apple Inc. designs, manufactures, and markets personal computers and related software. Apple also manufactures and distributes music players. Although I heard they don't make iPods anymore. Is that true? I heard that they didn't make the regular iPods anymore, so this is a little outdated maybe. Mobile phones and smartwatches, along with related accessories and services, including online distribution of third-party music, videos, and applications. The following information was taken from a recent annual report of Apple. And so for the current and the preceding year, you can see the total they had spent on land and buildings. Notice these numbers are in millions. By the way, if you didn't notice, all of the project ones have been graded, and you should be able to see your feedback, see my specific comments on that. There were several people who received a comment about what's the label on this? Is this in thousands and millions? And I'm pointing that out now because it tells us that these numbers are in millions. That's a critical difference in your annual report project. If you give me a dollar amount, but it's actually in thousands and you don't say that. So you should be telling me that. What is the label, or what units are those dollars in? So these numbers that you see here represent the original or historical cost of their land and buildings that they had this year, and the original cost of what they had last year. Then they have machinery and other fixed assets, and down here at the bottom, we have the accumulated depreciation and amortization. That internal use software is what would be amortized based on what I'm seeing there. And so we're asked to compute the book value of the fixed assets. So all three of those categories, land and buildings, machinery, and the other fixed assets, would be the book value, and then we would subtract the accumulated depreciation and amortization to find their current year's book value. So 17,085 plus 69,797 and 9,075. Then subtract the accumulated amortization, and I got a book value of 37,378 million. If you got that one, go ahead and do the same calculation for the preceding year. Everyone okay with that? Preceding year book value, $41 billion roughly. So a comparison of the book values of the current and preceding years indicates that they decreased, right? Went from 41 down to 37. A comparison of the total cost and accumulated depreciation reveals that Apple purchased. So how much did they purchase? Well, let me boxes here. So this is how much they had spent the preceding year, and this is how much they had spent in the current year. So to find out how much they spent between last year and this year, we would take this year's amount, again for all three categories, and subtract last year's amount. And I got 55.54. So their original or historical cost increased by 55.54, but their accumulated depreciation increased by, take this year's accumulated depreciation and subtract last year's. So their depreciation expense this year was 9,480 million, or $9,480 million. So they reported more depreciation expense than what they spent on new acquisitions. The last question is interesting because it is a judgment call on your part. Would you normally expect the book value to increase or decrease during the year? So you'd have to know, is this company growing or not? A growing company, you would expect the book value to increase. But a company that's just going along, a company that is maybe not a brand new and expanding company, you would expect them to decrease as they report more depreciation than they replace if they're not investing in new assets. So because Apple is a growing company, you would expect them to increase, even though we saw that they did not increase this year. It's one of those questions, it bothers me a little bit because I don't think there's a correct answer to what you would expect. You might be wrong, but in a growing company, you would expect it to be increasing. in a well-established company, you would not expect it to be increasing. So luckily you can do the check my work and change it if you had chosen decrease based on what you saw here. And we have one more exercise to go. Let me clear those drawings from my screen. Anybody questions on what we've done so far? Everybody's good? So let me share my screen again. Maybe. Here we go. For our final exercise, just like we have done for the past several chapters, is looking at what did we learn in this chapter? How can that help people make decisions about our company? And the financial analysis tool that we are learning in this chapter is called the fixed asset turnover ratio. In other words, how good are we at using the assets we have to generate sales? Sometimes you hear it just called the asset turnover ratio, or AT, asset turnover. You've got the formula there. Sales. How do we know what a company's sales are? Which financial statement do we use to learn that? Which financial statement would include their sales or their revenues? I'm going to take that as the correct answer. I'm going to change it a little bit though. And I'm going to because you've mentioned that, let me talk about that. So the answer that I would have expected is the income statement. But many of you correctly noted in your projects that your company that you chose for your projects also has a separate statement called the statement of comprehensive income. It's not something you've ever heard me talk about in class, and it's not something we're going to talk about other than to just briefly explain. There are some adjustments that GAAP requires, generally accepted accounting principles, require a company to make that adjust their income statement to a concept known as comprehensive income. So we are not looking at the comprehensive income statement in this class, that the starting point for that is the income from their income statement that we do know how to prepare. So you could see their income on the comprehensive income statement, but you probably would not actually see their sales, because it usually a comprehensive income statement starts with what was their income on their income statement and what changes do we have to that. So sales comes from the income statement. The denominator is the average book value of their fixed assets. Where do we find out about a company's fixed assets? Which financial statement? Which financial statement includes their assets? The balance sheet, exactly. So hopefully you made a note of that calculation, that formula, and let's go to our final exercise. Again, this formula or this calculation, the asset turnover, is a measure of how good is the company at using the assets they have to generate sales. And so the higher number is better. So let's do the calculation for 2015. We know that the numerator is going to be their sales from the income statement. And the denominator is going to be the average fixed assets book value. So they've already given us here, it doesn't say, but we can assume that this is the book value of their fixed assets. In other words, they have already subtracted out the accumulated depreciation. We want to add the beginning and ending values and then divide by 2. And I found a fixed asset turnover of 2.4 for 2015. Everyone agree with that? Okay, go ahead and do the calculation on your own for 2014 then. And for 2014, I got 1.8. We would read that as 1.8 times. In other words, for every dollar in fixed assets the company has, they're generating $1.80 in sales in 2014. And in 2015, for every dollar in fixed assets, they're generating $2.40 in sales. As I already said, the higher number is better. It means they're using their assets more efficiently or more effectively to generate sales for their company. So does the change from 2014 to 2015 indicate a favorable or unfavorable change? Favorable. They're generating more sales. They're using their assets better to benefit the company. And that is the end of chapter 9. We have just a few minutes left in class. Anybody have any questions, anything you want to talk about? Okay, so again, as I said at the beginning of class, this is also the end of the work for for exam number 3. But the problem isn't due until Tuesday, and so the exam isn't this weekend, but next weekend. So the first weekend in November will be exam 3. We'll talk about it on Tuesday. You can take it anytime after you finish the work for chapter 9, but officially the exam period is Thursday to Sunday. Just like with the first 2 exams, you have 3 hours. Once you start, you have 3 hours to finish it. And we'll look at it and talk about it on Tuesday. If you're able to join us for the review session on Wednesday, I would anticipate that we'll be looking at the practice set for the exam with the time that we have. So if there aren't any questions, we'll call it a day, a couple minutes early. Thank you for being here, and I hope to see you on Tuesday. Have a great weekend.